Transferring wealth successfully starts with asking yourself questions that will give your family a better life now and for generations to come. In this podcast, financial experts John and Michael Parise from Copper Beech Financial Group guide you through eye-opening questions to help you discover the truth about your wealth. Now, on to the show.
Hello and welcome to The Truth About Wealth with John and Michael Parise of Copper Beech Financial Group. Except we're missing someone today. We do have Michael, but where's your lovely father?
Oh, well, my lovely father's traveling today, so he couldn't make it. But we have a very special guest today, and we didn't want to delay this episode, so I'll be flying solo today. But I think it'll be great nonetheless. But we'll miss the big guy.
So, do you want to introduce our guest?
Yes, please. So, with us today is Greg Friedman, the CEO and managing principal of Peachtree Group. We're really excited to have him on the podcast today. So, good to see you again, Greg. How you doing?
Doing well, and thank you for having me on y'all's podcast. I look forward to spending time with you today, Michael, and Wendy as well.
Yeah, it's we've been excited to have you on for a long time, like I said earlier. So we got, I think, a lot to talk about today. But before we kind of jump in, I'd love to hear a little bit about your background, Greg, your firm, what you guys do, and then we can maybe take it from there.
Yeah, so my background, I grew up in a family that owned a bunch of real estate, commercial real estate, hotels, did a lot in the credit spaces related to hotels as well. So personally, grew up around the business I'm in today, although I never worked in the family business, and went to school at University of Texas at Austin, and today I'm actually in our office that's in Austin. So it's a little bit symbolic, I guess. But in any event, I graduated from Texas, actually moved to Atlanta, and spent about a decade after Texas in banking, where I was specializing in capitalizing and financing commercial real estate projects, primarily hotel projects across the U.S., and had financed over $10 billion of total project value before starting my business in 2007, being Peachtree Group. And I'm sure we'll talk more about Peachtree and what it does as a firm, and we're happy to jump into it now as well.
Yeah, I mean, starting the firm, a real estate focused firm in 2007, that must have been a pretty interesting sort of first couple years of your firm, but you guys have done a phenomenal job growing it since then. So you made it through okay.
Yeah, it worked out well. It sort of resembles the market today in a weird way, where it's there's a lot of one camp, there was a lot of optimism when we started our business in 2007, and because it was May of 2007 when we went out and bought our first couple of assets and really started Peachtree Group. And obviously I was much younger, had a lot more hair back then. But, back in 2007, we thought we were going to take over the world. Little did we know that, going back at the fourth quarter of 2007, that's when the market started to, really show major cracks in the marketplace. And it totally changed, the trajectory of our company and what we ended up doing. But we were able to, we were very successful in the fact that, early on, we bought a bunch of hotel real estate, pre-great financial crisis. And then post GFC, we were able to, quickly pivot and take advantage of, the market conditions that existed. So we were able to see sort of both sides, as well as, we became great asset managers because we had to play defense, very quickly because of, the great financial crisis.
Yeah, it was, I was in law school at the time, so I didn't get, I heard it tangentially, through my father and other his colleagues, but it was a difficult time. But yeah, you guys have really pulled through that for sure. And I wanted to say before we jump into, these guys have like one of the best teams that I've really come across. I mean, all the people that I've met over there, just super smart, really knowledgeable about your space. And so kudos to you for building a really, great team over there. It's fun to be around.
Yeah, we have an incredible team. So, thank you for saying that. But we've, because we started, when we started the company, it was just myself and my partner, and we've been able to grow it to where we have about 300, corporate team members across the different verticals that make up Peachtree. But we have an incredible, corporate team. We've got over 3,000 team members out in the field because, as we operate a bunch of hotels as well. We're a vertically integrated private equity firm. So we have at least for us, we have a large team, but we're very proud of how strong that team is because that's what really allows us to continue to execute at a high level.
Yeah, no, for sure. So yeah, let's jump into it a little bit more detail on what you guys do with Peachtree. Obviously, you have the hotel and hospitality background, but you guys have, like you said, a lot of different verticals. Can you give our listeners a little bit of an idea of kind of at a high level what you guys do? Because it's again a lot, and with a phenomenal team, it's a wide breadth. So maybe you can give a little bit of a kind of breakdown on that side of things.
Sure. So we, invest up and down the capital stack as it relates to commercial real estate. We have some investments outside of commercial real estate as well. But when I say invest up and down the capital stack, so we make, debt investments or credit investments where we're doing direct lending or buying loans from banks that are looking to deleverage their exposure to commercial real estate. We actually do some lending outside of, real estate as well. Like for instance, we have a media finance business where we actually finance the production of films. But we are, very active on the credit side. And when I say equity investments in commercial real estate, that's us going out and buying an asset where we end up owning, if it's a hotel asset or a multifamily asset, we end up owning that asset. And internally, we have different teams set up to, operate those assets, to asset manage those assets that we, own on the equity side. But we also develop assets. We have a development company that will build assets from the ground up. So to really summarize it, Peachtree as a company, we're really in the mispriced risk business. So we're in the business of finding, mispriced risk and taking advantage of that for, for our stakeholders. So it's for us as investors in the different vehicles that we sponsor, along with, with the, other groups that, partner with us or invest with us as well.
Yeah, so that's great. Thank you for that. And I was hoping to get your thoughts on, you mentioned the commercial real estate market a little bit earlier. What are you guys seeing out there? Because, when we talk to our clients, I think, well, a great many of them, almost all of them, love real estate. They love investing in real estate, but it's a really challenging market out there. I think you would agree in a variety of ways. So can you educate our listeners on sort of what you guys are looking at in the commercial real estate market? Maybe some sectors you like, some sectors you don't like?
Yeah, so I think, just taking a step back, real estate, commercial real estate, and even residential real estate, it's all under some level of stress today. And it's all for primarily balance sheet driven within commercial real estate, because we have higher for longer interest rates. And so you have, all this debt that's maturing that's causing just a lot of, challenges, it's causing a lot of complications. And it's, a lot of, confusions in the market as well, just because, everyone's trying to figure out how to value these assets, because we went from an environment where the 10-year average closer to 2% for the last, 12 years pre-2022. And, you look over the last 3 years, the 10 years average over 4%. And, there's some arguments that the 10-year could end up settling above 5% when it's all said and done, depending on, if we end up in an economic recession or not. So, I mean, the reality is, the economy, if the new administration is successful in, implementing what they're trying to do, there's a very good chance, we end up with a 10-year that stays where it is right now, being closer to 4.5% or higher. And the reason I mention all that puts a huge headwind on the values of these assets. And so if you're, refinancing an asset where you bought it, 5 years ago and you bought it for 100 million, well, most likely, the value is down probably 20% on average. So it just creates the need for additional liquidity. And so us as a firm, where we're really leaning into, although we do make equity investments, and we're seeing a lot of these special situations where we can buy stuff opportunistically, where we're seeing the best opportunities right now is really within the credit space. It's us coming in and being a lender to help, groups either refinance, recapitalize existing assets that they own that are facing this wall of debt maturities, because you have over $1 trillion of loans maturing over the next, call it 12 to 15 months. So you have this huge, front end load of just this wall of debt maturities that are causing challenges right now. And it creates an opportunity for us to be able to get, really mispriced risk. So we're getting, really good risk adjusted returns on the, on the loans that we're making, which these are first mortgage loans secured by commercial real estate assets. We're also very, we're very constructive and looking for these, special situations. But, we really do like, when you look across the different property types, I mean, we like multifamily, we like hotels, we like, what's happening across like the, the residential space when you look at horizontal land development loans, where you're, helping developers finance these, lots that public, public builders are, effectively entering these takedown agreements. We are, providing financing to these developers where they have that takedown agreement in place. In certain cases, we like that space as well, because in all of this, although there's a lot of complexities, there's a lot of chaos in the market right now. We do believe long term, we believe in the resiliency of the U.S. economy. We believe long term, the fundamentals are still very strong across most property types because supply is very constrained on a go forward basis.
Yeah, that was all awesome stuff. But I'd like to, if I can, touch on something you alluded to regarding interest rates today being higher for longer and maybe even higher by the end of the year, because that's something our clients ask us a lot about. And I've heard varying thoughts around, are we going to get interest rate cuts this year? Are they going to stay where they're at? And I'm interested, obviously, sounds like you think that they're going to stay higher for longer, if not go higher from here. But interested to kind of get your rationale why you think that's the case. And, because again, it just seems like there's a lot of, I don't say confusion, but there's just differing opinions about what's going to happen in that world, which is a huge impact, not just in the real estate market, as you know, but across the economy and the investing world.
Yeah. So, there's a lot of, like, back when I was in banking, we spent a bunch of money to buy data on a forward view of where interest rates were going to be, and it was never right. So I'm going to start out with, I've never seen anyone be able to get it right. So I'm not saying that I'm going to be correct on this, this whole thesis, but I do believe that, at least we're underwriting, and we're taking a very conservative view on how we underwrite on a go forward basis. And hopefully rates do come down a lot lower than we expect. And if it does, for our underwriting, we do extremely well. If rates stay, higher for longer, even if they go up a little bit, we're still very protected in the investments that we're making, given how we're underwriting our, loans that we're making or the, assets that we're buying today. But with that said, our rationale is that, short-term rates are probably going to drop. So eventually the Fed will probably start to reduce rates at some level, we believe, later this year. So we don't think, it's impossible that we could see 2 or 3 cuts. 2 cuts are probably more likely. And, the reality is the new administration has, they have their tax bill that they're trying to push as we speak right now. That's going to be, somewhat inflationary. You've got, you really have, you just look at the tariffs. Obviously, that's helping potentially drive inflation at some level. Maybe it doesn't, maybe it's not as impactful as people originally thought, but it's still an inflationary event. And so that's going to be the headwind as the Fed is looking to reduce rates, assuming the job market remains as resilient as it has up until now. They're not going to have a lot of coverage to drop short-term rates. The reality is the bond market is usually a little bit ahead of everything. So the 10-year treasury rates actually, even as the Fed started dropping rates over the last year, and they've been very slow in the drops, but even as they started to drop rates, the 10-year's actually gone up. And so the reality is, most people are expecting that the new neutral rate, when you look at the federal funds rate, is going to be a lot higher than what we experienced, that pre-2022, period for that decade, pre-2022. And because of that, that's what's going to be the, the factor that's going to keep, when you look at the 10-year treasury rate, it's going to keep it higher. And the reason I keep mentioning the 10-year treasury rate, that's really the risk-free rate. That's how you value commercial real estate assets. You use that and you apply a risk premium spread, which is ultimately your cap rate when you apply that risk premium spread. That's how we look at what is the true intrinsic values of these assets. And if the 10-year stays higher, then the values of these assets are going to be, lower by, some portion. And that's something you have to take in consideration when making investments today.
Yeah, that was great. I tend to agree with a lot of what you said. I think that it's with all the reasons you mentioned, I think it's going to be a little bit of a different interest rate environment than some people think in terms of going back to, the 0% interest rates. I like you said, it's very difficult to predict this, but I don't foresee that in the near future at all. But we'll see what happens. But as a corollary to that, to get back to sort of the credit business that you guys have, I'm interested to hear, sort of who your loans are made to, and if those borrowers, if they're trying to develop a piece of real estate, if they have a project that they're working on, why not go to the bank? I think that's really important for our listeners to kind of understand where you guys sit and why you sit where you sit, because I think that's, again, given where interest rates are, it's probably making these development projects a lot more difficult, I would imagine, through the traditional means, right?
Yeah, I think, you look at our typical borrower, these are regional owners, operators, developers of commercial real estate assets. So if it's hotels, multifamily, retail, industrial, whatever the type of properties, usually we're financing these regional groups. Some cases it may be a national group. Most cases it's a regional owner operator that has a lot of, they have a lot of institutional knowledge of these local markets that they're operating in. And typically the reason they're coming to us over a bank, because we are more expensive than a bank, but there's a couple of reasons. One is, the banks are broken in general today. So banks aren't lending at the same levels that they once, were able to lend to, nor are they able to serve their customers in a lot of cases because they've become so, deposit focused. So we don't, we don't require deposits for our institution because we're not a bank. We don't have a, bank charter. So that's one reason we end up winning a lot of business, is that, these borrowers can't move 10 to 20% of the loan amount into deposits into a bank to get that bank loan. Another factor is, most banks today are very conservative in how they're trying to underwrite credit because they have a lot of challenges within their existing books. I mean, there was, just the other day, there was some data that came out that showed that there's $500 billion of unrealized, losses across, all the banks in the U.S., their balance sheet, right? And this is within their securities book. So if they had to go trade that portfolio, that's 500 billion of capital just wiped out. And, the net asset value across the U.S. is roughly, I think, about 2.3 trillion when you look at the total bank balance sheet. So a lot of these bank balance sheets are relatively fragile, and their ability to allocate, more capital into, real estate lending today is very is very unlikely, just given some of the challenges that they're facing internally. So, it's hard for a borrower to go to a bank to get a loan at the leverage levels that they once were seeing pre 2022, because banks have been just very conservative in this environment. And so in most cases, we're providing loans that are 65 to 75% of acquisition costs, of the total value of the assets. In a lot of cases, we're even below those leverage points. And the typical bank today is lending at 50 to 60 to maybe 65% of acquisition costs and value. So we're able to provide that higher leverage. And so although we're more expensive by 2 to 3 points in a lot of cases, it's still accretive for the borrower to work with us versus that bank. And then finally, and there's a lot of other reasons than this final reason I'll give, but it's just our speed of execution. When borrowers, especially in this kind of environment, they've got to move quickly. They've got to be very decisive. And it does not, if you've got if you have your loan that's maturing and you thought you had another lender, like another bank that was going to provide it, and last minute they don't show up and actually finance it, then you're under the gun. You can't go find another bank, because the banks typically just take, 60 to 120 days, in some cases longer, to go through their process. Our average loan, we're usually moving in 30 to 60 days. So that, just that speed, as well as our ability to, provide certainty and execution, is why a lot of groups come to us for that acquisition financing. In some cases, we do development loans, for new construction, or even, we do a lot of refinances in this market where, loans are maturing and someone needs to refinance the existing loan that's in place.
Yeah, no, that's thank you for that. That was exactly what I was looking for. Yeah, that was great. How do you, from an underwriting perspective, what do you guys do? So you said there's a difference in time frame that you guys, in terms of getting a loan done versus a bank. The follow-up questions that I would have is, well, what sort of underwriting are you doing on these borrowers, and is there a risk of default? And if so, kind of what does that look like? Because obviously your investors, I'm sure, have asked you that a good amount.
Yeah, so historically, our default rates have been really low. So, less than 3% of the loans that we've acquired, that we've made, we've ever been forced to actually foreclose and take back those assets. So we've made over 600 credit investments, and we've taken back less than 3%. So you're talking about us taking back a little over a dozen assets that we've been forced to foreclose. And I mentioned that we bought a bunch of loans because we have bought, call it close to 300 loans where these, roughly these 300 loans were non-performing loans, where a lot of cases borrowers weren't making payments, or they were making partial payments, they were subperforming. And so even with that whole portfolio of the 300 plus loans that we've originated, these first mortgage loans, or even the close to 300 loans that we've acquired, across both those books, we've taken back less than 3%. So normally borrowers will refinance us. Our underwriting, and the reason we have such a low default rate from our perspective, given that we are taking on a little bit more risk than a traditional bank. So you would expect our default rates to be a little bit higher, as it probably is. But the reality is we have really disciplined underwriting standards, and a default to us, like where we have to foreclose, is not a bad outcome either for us, unlike a lot of banks or other lenders that are under some type of regulatory scrutiny, because we can step in because we own real estate. We understand what it takes to own commercial real estate. So we can step in and fix these assets. So a lot of times the assets that we have foreclosed on, we've actually gotten not only a positive return, but in several cases, we've gotten returns that were much better than we originally anticipated by even owning the real estate, just because we have that asset management knowledge, we have that operating knowledge, that ownership experience on the real estate side. So a default is not a bad outcome. It actually can, in some cases, lead to a better outcome than what was originally projected. But we really attribute all this to the fact that we underwrite not only just like what a traditional bank will do, like pulling credit reports, underwriting the cash flows and looking at the sponsors and the location, but we actually, we underwrite it as if we're going to own the real estate as well. So we take a very much an ownership view and really dig into like the insurance and the property taxes and the operating expenses, and making sure it's all these assumptions are reasonable and achievable before making that loan. So I think us taking that more ownership view of the asset, although we have no intentions of ever owning the assets we lend to, it gives us a huge advantage on being able to make sure we're making loans that are high quality and that have a lower default risk.
Yeah, no, that's great. What regions do you guys look to primarily? Do you have a sort of a preferred area of the country that you look to? Is it really just based on the property or the project that you're looking at, and irrespective of geography? But I hear when I go to a lot of meetings and I hear whether it's people or companies in your sector that do similar investing, it's sort of go where the population growth is, right? So the southeast of the U.S. is a very common region that we hear a lot. Is that where you guys look to, or is it a little bit different?
Yeah, I mean, we pretty much go Southeast, Texas, Arizona. We love those markets. I would say that from an ownership of real estate, when we own stuff on the equity side, we tend to focus on those regions. Texas, Southeast, Arizona. We like the Mid-Atlantic too, to a certain degree. We tend to be very cautious going in the Northeast, California, the Midwest, and so forth. But on the credit side, when we're making loans, we tend to favor those locations as well. But we're willing to be opportunistic too. If we're at the right basis, we'll go anywhere in the U.S. So we've made investments pretty much in call it over 90% of the states across the U.S. So we've made investments where we either bought loans or made loans. We tend to be more opportunistic if we're going to go into like a market like California, because there's a lot of challenges, just from a business friendliness and, what's happening in that state. So we tend to, look at what's happening from a, just from an operating environment to make sure these are environments that we would feel comfortable if something goes wrong with the borrower, that we have to own that real estate. So we tend to be very focused on making sure we're going into the right type of markets. But even then, like the Northeast, California, we will still make investments in all those markets. We do have, several investments in both those markets. And it's really, based on, how we look at, what's happening at the underwriting asset level.
Understood. I'd love to, if I can, to shift maybe towards the investor side of what you guys do. So you guys are going out and raising capital, whether it's on the credit side or the equity side. Who's your typical investor that you're looking to in terms of wanting to raise that capital? So what are the parameters around maybe some of the vehicles or the funds that you put together that our listeners should be aware of?
Yeah. So usually I would say the, typical group that likes to, partner with us are groups that are, we have a lot of high net worth individuals, family offices, registered investment advisors that will allocate capital for their clients. We have a lot of institutional investors, very, well-known institutional investors that will invest into our fund vehicles or invest into other vehicles that we sponsor and so forth, or we'll set up, certain accounts for these, institutional investors. So they do make up of all, type of groups. The reality is, we tend to be very attractive to a lot of different groups, just given the fact that we are so dynamic in how we invest capital, how we're always, able to pivot between making credit investments or equity investments, depending on the opportunity set, and our ability to be very decisive and continue to be very entrepreneurial, even as we've grown, it provides a very attractive area for someone that's looking to allocate into commercial real estate or into some of the other asset classes that we've talked about. We feel like we provide an ecosystem that's very compelling for them.
Great. Yeah. Thank you for that. If I can shift gears to something, because I think this is a really cool part of your business that you alluded to at the beginning when we started, which is your film finance sort of vertical that you have within your company. I'd love to hear a little bit more about that, and because it's not a very common avenue that most investment firms go down, but I think that'd be really cool to have our listeners learn a little bit more about that, if you don't mind.
Yeah, and it's super uncommon. Like people hear it, they're like, "Wow, Peachtree's become so creative. Like, what's going on over there? Are they making movies? Are they making films?" And the reality is it sounds a lot more interesting than what's really happening. Because I found a long time ago, being boring is actually a good thing, because you tend to make a lot more money being boring than trying to be something that that's a little bit too creative. So we within the film space, we actually are financing the tax incentives as well as the distribution rights that are associated with these films once they're made. Because most films today will either have they'll have a theatrical release. In some cases, a lot of them don't have a theatrical release anymore, but many of them still do as well. And then after that theatrical release, or if they don't have one, they go straight to these streaming services like a Netflix or Amazon or whatever the case may be. And so these streaming services, and there's some other organizations that will do the same thing. They'll step in and say, "Hey, we want to buy the rights to distribute the film in the US because we see this film having so much potential. We want the rights to it." So on the front end, before the film's ever made, Netflix, is a good example. They'll say, "Hey, we'll pay you, X dollars on the front end once you complete the film." So when we're making a loan, we're not just blindly making a loan, because we're not investing equity in the film space. We're investing through the debt piece. We're making first mortgage senior loans. So when we make that senior loan, we have visibility to repayment, because our repayment is going to be these tax incentives, which are tax credits that are, we will receive as long as the film is made and they spend the money as they're supposed to within the budget. And then the distribution rights, we can see which rights have been sold, what territories across the world, because you can sell it domestically, internationally. It's broken down by all these countries. And we can say, okay, well, we have X millions already pre-sold, and we're going to have X millions in tax credits. And then we can make a loan against that, plus take the unsold territories as additional collateral. So we're we're over collateralized in most cases on the loans that we're making. And so we argue that this is really mispriced risk, because you look at the underlying, credit, what's, your source of repayment. It's very, it's very low risk. I don't want to say there's no risk, but it's very low risk. And it all comes down to, within the film space, it's all about the, just getting the film produced. And you can actually enter into a bond that effectively guarantees the completion of the film. So as long as the film's completed, the Netflix or whoever's obligated to buy the film, regardless of how the film turns out, the tax credits, the tax incentives that we're going to monetize at the end of the film, they don't care how the film turns out. If it could be the next top hit, or it could be a film that's not that compelling to watch. Either way, we still get paid, and so we like that business because it's really just receivable finance. And we think it's mispriced risk based on the type of returns we're able to achieve. Plus, we're able to get equity kickers associated with a lot of these films as well. So we think it's a very attractive space if you know how to operate in that space. And so we've been very successful. We've financed over a dozen films, and it's an area that we anticipate we're going to continue to grow into over the next several years.
Yeah, that's really cool. Thank you for that. Now, these tax incentives, are they at the state level primarily, or federal level? And does it matter where you live to get, it's based on where the film is produced. Is that correct?
That's right. So
okay.
Most of it's where the spin occurs, right? Like for instance, in Georgia, a lot of films are made in the state of Georgia, and there's a state tax credit program there. There's one in Louisiana, Kentucky. And then we've financed actually a fair amount of films made in Australia, although it's produced here in the US. A lot of the shooting took place in Australia. And we were able to get, or at least the filmmaker was able to get an Australian tax credit that we were able to monetize to help, cover our loan and pay it down. And, that's worked out super successfully. Like we financed a film called Sleeping Dogs that had Russell Crowe and several other actors and actresses. And it was a successful, venture for us. We just financed another film that actually was previewed at South by Southwest. That was called We Bury the Dead. That's a film that we believe will do really well. It's actually very well done film, but and it's working out very well for us just based on what's happening there. But in both cases, they were able to get a tax credit over in Australia that we were able to monetize and pay down our loan as well.
Yeah, that's cool. I know that I think Netflix is building a pretty $1 billion plus studio in New Jersey, where I live, kind of up the road, about an hour away. So I don't know if there's going to be any New Jersey tax credits anytime soon, or maybe they currently exist. But yeah, it's interesting to keep an eye on.
Yeah. So we actually financed the film, and I think it was in Jersey City, if I'm not mistaken. It was called Motor City recently. That was made, and that was a film that was done in New Jersey, and we're very aware of the Netflix facility, there in Ocean, because we actually own a hotel in that market that it's a Marriott Residence Inn, and it's something that we've done it through our we have a program where we effectively buy assets with 1031 capital through the DST market. We're a DST sponsor. And we own an asset in that market where if someone's trying to be very tax efficient, they can invest into that strategy as well if they're selling, a like-kind commercial real estate asset.
Yeah, no, that's great. Yeah, we didn't. Well, we're going to have you on again to kind of go through the DST market, because I think we're unfortunately running out of time here. But I wanted to, before you kind of have closing thoughts, just thank you again for being a part of the podcast here. But love to hear any sort of closing thoughts you guys have, or you have, on where we're going economic wise, you guys at Peachtree, and hopefully we'll have you on again soon.
Yeah, I think it's a very interesting environment today. I think it's going to be, there's no question that the first, call it 4 or 5 months of the new administration's been anything but boring. So it's been very chaotic. And if you're trying to make investments, it's very hard to figure out the right way to make investments. I think it's going to be a very chaotic and volatile, next 6 months or so. Fortunately, I think there's a lot of things that are coming together. And I think it's going to be a very constructive environment here shortly, where it's going to be extremely compelling on making new investments on the equity side. I think it's a very compelling environment to invest in more defensive strategies right now, like on the credit side. We view that as a very defensive way to invest capital. And I think long term, there's a really just good setup when you look at what's happening in commercial real estate and just the lack of new supply getting built, which should really pay dividends for owners of assets when you look 2 to 3 years out, because rent growth is going to be much stronger than what most people anticipate, because there's just, new supply is anemic at this point. And, I believe in the U.S. economy, and I think the new administration is doing a lot of things to help grow the U.S. economy, which is a huge positive when you look in 2026, 2027. So yes, we're going to have to deal with some headwinds, being higher rates for longer, but I don't see that necessarily, unfortunately, there'll be some pain through it, but there's going to be a lot more to gain long-term by being invested, within the U.S. So I'm super excited about the outlook.
Yeah, it's great. There's always an opportunity, right?
That's right. So every headwind creates, it creates the next opportunity.
Yep. Great. Well, Greg, thanks so much again. Really appreciate you taking the time, and I know we're going to have you on again soon, because this has been great. So thank you.
Yeah. Thank you, Michael. And it was good to spend time with you too, Wendy.
Well, thank you so much. Michael, how do people get in touch with you if they have some questions?
You can reach out to us on LinkedIn. Copper Beach has our own page. You can reach out to me on LinkedIn. If you want to give us a call on the phone, number is area code 856-988-8300.
All right. Thanks to both of you. And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to the Truth About Wealth podcast. Click the subscribe button below to be notified when new episodes become available.
This material is for informational purposes only. Neither Osaic Wealth, Inc. nor its representatives provide tax, legal, or accounting advice. Please consult your own tax, legal, or accounting professional before making any decisions. Copper Beach is not affiliated with Osaic Wealth Incorporated. Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Additional advisory services offered through Copper Beach Financial Group. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. These opinions are subject to change at any time without notice. Any comments or postings are provided for informational purposes only and do not constitute an offer or a recommendation to buy or sell securities or other financial instruments. Readers should conduct their own review and exercise judgment prior to investing. Investments are not guaranteed, involve risk, and may result in a loss of principal. Past performance does not guarantee future results. Investments are not suitable for all types of investors. Any opinion expressed in this forum is not the opinions of Osaic Wealth Incorporated and have not been reviewed by the firm for completeness or accuracy. Osaic Wealth Incorporated and Copper Beech Financial Group are not affiliated with any other named business entities mentioned.